Welcome to Exchange Traded Fridays, brought to you by ETF.com. I'm your host, Sumit Roy, Senior Analyst here at ETF.com. As always, we got another action-packed episode lined up for you all today, but we also have some bittersweet news to share with you as well. This is the last podcast that Jeff Benjamin, our dear colleague here at ETF.com, will be joining us on, at least in his official capacity as wealth management editor. We're going to find out why Jeff is jumping ship in a second. But first, here are the topics on tap for today's podcast. First up, we got Nvidia's earnings and what it means for ETFs. Then we'll be talking about the record outflows from crypto ETFs. And finally, we'll touch on State Street's new private credit ETF that began trading this week. We got a lot to cover, so stick around. Joining me today, our senior content editor, Kent Tooney, and of course, wealth management editor, Jeff Benjamin. So Jeff, why are you leaving us?
Well, thank you, Sumit. I am retiring. It's time for me to go check out some other things in my life. I have enjoyed my time here at ETF.com, almost 2 years. We did some great things, had a lot of fun. I learned a lot and enjoyed all my time working with you great people here and doing these podcasts, webinars, writing stories. It's been fantastic, but I'm 102 years old and it's time for me to go find some fun in retirement.
You earned it, Jeff. I mean, you've been such a great colleague. You've been such a great co-host on this podcast. I've loved working with you. One of the funniest guys, one of the most genuine guys I've ever worked with at ETF.com. So we're going to miss you.
Thank you. Thank you very much.
Yeah, I'll second that, Jeff and Sumit. And also, you get to live the life that a lot of the content that you've been writing on, advisor space, wealth management, retirement. So you already have it set up for you.
Yeah, hopefully my decades of work in the wealth management space, reporting on it, has taught me a few things. I know I've always appreciated financial advisors and industry professionals giving me free advice, even though whether I was writing a story on it or just curious. I know it's helped me a lot.
Well, Absolutely. Enough of that sappy stuff, guys. Let's get into the podcast.
Yeah.
Let's start with by talking about Nvidia. There was so much anticipation heading into this earnings report Wednesday after the bell. But as I wrote, earlier in the week, it seems like Nvidia's pull on the broad stock market isn't quite what it used to be. You guys might recall back in late January, there was this huge sell-off in Nvidia because of China's DeepSeek AI model. In a single day, Nvidia fell 17%. Over 2 days, it fell something like 25%. But I look back and the S&P 500 only dropped 1.75%. While Nvidia tumbled. So it didn't really drag the market down by all that much, even though Nvidia was the largest holding in the S&P 500 at something like 7%, which is kind of surprising, right? Last year, everyone was talking about Nvidia. If the Nvidia trade ends, it's over for the broad stock market. That hasn't happened. And likewise, we just got earnings out for Nvidia, and the immediate reaction, I'm watching this on Thursday, midday, Nvidia's down 3.5%, yet I'm looking at SPY and it's flat on the session. I mean, does that surprise you, Kent? Is that Nvidia can go down like this and nothing's really happening to the broader market?
Definitely not surprising. I mean, you've been following Nvidia as closely as anyone here at ETF.com. I'm sure you'd agree with the earnings beat. The expectations are always extremely high, or they have been for the last, 10 or 12 or 15 quarters. I don't know, for the last couple of years at least. And this was a solid beat, but it wasn't as strong as it had been in the past. So it appears as if kind of a sell the news type of a story. I mean, the price was coming up a little bit the day before and the day of the earnings, and now following earnings, I wouldn't call it a big sell-off. I mean, it dropped something like 17% or so after that DeepSeek panic, if you want to call it that. But down 3% for a stock is that big and potentially as volatile as it could be. Not surprised, but it's not a terribly large move either.
Yeah, you're right. You're right. I think I read ahead of the earnings, the options markets were implying there'd be a 10% move in either direction. 3% really isn't all that much. I mean, it moves 3% every other day from what I can see. So the impact, obviously, on the broader stock ETFs isn't much. Are you seeing any movements in terms of more industry-focused ETFs like SMH, or not so much there either?
There is a slight decline in SMH as well. The broader semiconductor ETF, other artificial intelligence space companies, we're seeing some declines as well, like AMD and Broadcom and Intel, Supermicro Computer also. So the entire industry still really is following Nvidia. Now, from what I can tell in their call, I mean, they're saying, in translation, artificial intelligence is still very much alive and the growth phase is still there. But maybe the valuations are a little on the high side for a lot of investors' comfort level, and so they're just not ready to have large positions at this time.
Yeah, it certainly
Mhm.
seems that way. It seems to be in a holding pattern, this whole AI trade. If you zoom out on the Nvidia chart, it hit $135 per share back in June of 2024, and it's been fluctuating, give or take 10% or above or below that level since then. We've had scares, we've had moments of euphoria, but essentially it's been flat here after that massive, massive run. After ChatGPT came out in late 2022, the stock just went through the roof. We'll see what happens. Obviously, Nvidia on their conference call, they were very bullish. Jensen Huang had a lot of positive things to say. There's been concerns, obviously the DeepSeek thing caused concerns that demand for NVIDIA chips might not be as robust. If you can train these AI models with far fewer chips, maybe you don't need to be spending tens of $billions on NVIDIA's powerful GPUs. But I think people still realize that for the most cutting edge models, at least, you do need NVIDIA chips. The question then becomes, what happens, for running some of these models, right? You create the models using NVIDIA's GPUs, but then when you actually utilize these models, make queries on them, you might use cheaper chips, like the custom chips we're seeing built by Microsoft, by Amazon, in partnership with companies like Broadcom and Marvell. So there's that whole debate about whether NVIDIA is going to be as big on the inferencing side as it is on the training side right now. We'll see what happens with that. That debate continues to rage. We'll be keeping a close eye on this stock going forward. But, NVIDIA wasn't the only, place where we saw action this week. Crypto saw a ton of action, and it's kind of surprising, actually. The spot Bitcoin ETF segment had its largest single day outflow ever on Tuesday. $1.1 billion came out of these funds. And we've seen crypto prices tumbling. Bitcoin is down 10% this year, fell as low as 82,000 or something like that. And Ether is down a whopping 33% just since the start of the year. Fell as low, I think, as 2,200 or something like that. What do you think's going on, Jeff? Is the whole, crypto bullishness that we expected after Trump won, is that all priced in? Why is it going down when seemingly there's so many positive developments coming out from the Trump administration when it comes to crypto?
Well, it seems like there's a few things that are driving the volatility in this in Bitcoin right now in crypto, and as we've talked about a lot on this podcast, volatility is kind of the trademark of cryptocurrency investing. I was talking to Rick Edelman, the Digital Asset Council for Financial Professionals, earlier this week. He cited three things that he saw as the catalyst: the Trump administration's talk of tariffs seems like a threat to economic growth, GDP. We've eclipsed the 1 year mark for the first spot Bitcoin ETF, so there could be some profit taking there. And then there's that Ethereum heist, the $1.5 billion Ethereum heist that he said might have given people some jitters on crypto investing. But I don't know. To me, you always hear people celebrating, maybe people that are, kind of not deep in the weeds, but you hear them celebrating crypto when it's setting all these crazy performance records and stuff like that. But this kind of a pullback, I think it's natural. It's healthy. It's sort of like what we're talking about with AI. These things have to move in both directions to create these buying opportunities. I personally see this as a buying opportunity, but I'm not
Yeah.
sure everybody would agree with that.
Yeah, I mean, crypto has always kind of been this volatile asset, right, Ken? It's never a straight line up. There's always ups and downs.
Right. I take a peek every now and then at what technical traders are doing. They're following closely support levels, and I think the next one is in the low 80s range. I think right now Bitcoin is, well, I think it's around 85, 86,000 right now. So, yeah, well, it'll continue to be tested, but overall, I'm with Jeff. I mean, if you're going to invest in crypto of any kind, and Bitcoin is the largest one, you have to be on board with the volatility, and you have to have a plan and stick to it. I mean, that's the case with any security, but even more so with Bitcoin. And it has been kind of moving a little bit. You were writing Samit on gold versus Bitcoin. Have you noticed somewhat of a correlation between their movement? I know the price of gold has been going down as well.
It has over the past couple of days, and obviously there was a very strong correlation last year when both Bitcoin and gold went through the roof. This year, though, if you kind of zoom out and look since the start of the year, there's actually been quite a big divergence between gold and Bitcoin. Bitcoin is down 10% this year, gold is up 8% this year. So they're acting quite differently. And if you look at the flows, it's actually quite different. We've saw these huge outflows from Bitcoin ETFs over the past few days, record outflows, but gold inflows have been picking up. People have been putting money to work in gold ETFs. In fact, year to date now, gold ETFs have collectively seen something like $4 billion of inflows, which is more than the $2 billion of inflows we've seen in crypto ETFs. So this is something that gold bulls will be smiling about, for at least a few years now. Gold has been overshadowed by Bitcoin and crypto. A lot of people thought, gold is kind of old fashioned and the new generations favor Bitcoin, but certainly seems like there's still a place for gold. It still has the opportunity to outperform. And these are obviously very different assets. A lot of times people call them both safe havens, but the way they move and their correlation to other assets is very different. Gold has obviously been around for thousands of years. It's has a very long track record. It's not nearly as volatile as Bitcoin. So if you're looking for that portfolio diversification, um, that asset that's not correlated with stocks, then maybe gold is the better bet, right? Whereas, Bitcoin potentially has more upside, but it comes with more downside as well during periods where we see tech stocks sell off, like the QQQ. We've seen that drop 4 days in a row earlier this week. That is a weight on Bitcoin a lot of the time. So two very different assets. We'll keep a close eye on both of them. But yeah, there is a big divergence between gold and Bitcoin this year, almost a 20% spread. And we're not even 2 months into the year. So we'll see what happens
Wow.
with that. Yeah. So yeah, let's turn to our third segment now. Jeff, I know you have a lot to say about this. It's actually concerns the Spider State Street Global Advisors Apollo investment grade public and private credit ETF. Quite a long name there, but the ticker symbol is PRIV. This began trading on Thursday. We first heard about this fund back in September, but now it's been officially approved by the SEC, hence the launch this week. This fund is going to target an allocation of 10% to 35% in private credit, with the rest of the portfolio made up of more liquid public credit instruments. Jeff, now that this ETF is finally here, what are your thoughts?
Yeah, this is an interesting one. This is, I know the Apollo and State Street, they would like to call this groundbreaking. It's groundbreaking in the sense that it's the first ETF that allows this much exposure to what we would describe as illiquid assets. Less liquid is the better name because they are liquid somewhat, but they're private credit. This is basically an ETF that's holding securities not traded on public exchanges. But it's a small percentage, 10 to 33%, which is I'm assuming that they believe they can still manage this portfolio and keep it as liquid and transparent as normal or traditional ETFs by with the public securities around that allocation of private credit. But what this really signifies is it's another step. It's actually a big step toward what people like to call the retailization of private investing, private equity, private debt, venture capital exposure. These are areas that are traditionally kind of limited to high net worth investors or institutional investors that meet the net worth or income qualifications to be able to invest in private funds. Now, private funds, they come with higher fees. They have long lockup periods sometimes. But they've been going after, they see the growth in the ETF space, and they're like, let's us get a piece of that action. And this is, a pretty big bite. But remember, it follows by just a couple of weeks the launches by Pacer. There's a Pacer PEVC ETF. Ticker is PEVC. And there is another one called PEO Alpha Quest thematic PE ETF. Ticker there is LQPE. Now, both of those funds, those are ETFs that are not directly investing in any private equity or private credit, but they're investing in indexes to provide a proxy for that the kind of performance you might get with private equity and venture capital. So it's my gut tells me that this is a product in search of a market. And I know that the issuers won't like that perspective, but to me, if you are of the sophistication level that you can invest or want to invest in this sort of thing, you probably qualify to invest more directly in private equity. Now, granted, these ETFs, the new one, PRIV, that came out, that charges 70 basis points. That's a heck of a lot cheaper than traditional private equity, which might charge 2% of assets and take 20% of your performance. So maybe from that perspective, this is going to be attractive. But performance, it'll all be determined by performance. If these things can't perform, why would you even go down that road? I don't know. It'll be interesting to see how much assets these things gather. Financial advisors as the biggest users of ETFs, will they put their clients' money in this? I don't think your garden variety DIY investors is going to be saying, yeah, I need to get myself a 10 or 35%, slice of private equity. Now, keep in mind that the big distinction here is the liquidity factor. These are basically trying to give you exposure to illiquid asset classes in probably the most liquid investment wrapper out there, the ETF.
Right. Yeah. Jeff, I was just looking at that too. The groundbreaking part appears to be State Street's working with Apollo to make or get around the SEC's definition of illiquid. And so that whether the fund performs well or not, or is widely accepted or embraced by advisors and investors, maybe it opens the door to similar kind of liquidity or getting around the SEC's rule of illiquidity. So it just points to the innovation and flexibility of ETFs in general.
Yeah. Mm-hmm. So it sounds great in theory, right? But we'll have to see in practice what happens. There's been a lot of controversy since, State Street is dealing mostly with Apollo. What type of private credit securities are they gonna sell to the ETF? Are these gonna be good quality, right? Obviously, they're all supposed to be investment grade, but there's probably a wide, spectrum of quality within that bucket. And Apollo has all of the information. The ETF I feel like doesn't necessarily have as much information. So is it going to make good purchases on that end? So we'll
Yeah,
see.
yeah. My
Yeah,
question again goes down to demand. I mean, I would never discount the resources and the knowledge and kind of perspective of something like State Street Global Advisors or any of these other ETF issuers. They're not issuing these ETFs willy-nilly. They've done their due diligence on this thing and they think there's a market there. I just don't know where the market is. I mean, and granted, the market is the entire investing universe, so it might be there. But man, I gotta see the flows into these things,
yeah,
and you know how it works. It's got to have performance to have flows. It's got to have flows for it to get to a certain level for financial advisors to look at it and stuff like that. It's I don't know. I think this isn't the kind of thing that grows quickly. But it would be interesting to see how it grows.
yeah. No, it's a great point, Jeff. We'll see if it grows, and if it does grow, what happens when the markets start to go down, right? If we see a
Hmm.
panic environment across financial markets, what happens? Because apparently there's a limit to how much Apollo will buy from this ETF each day. So theoretically, if you get big redemptions in this ETF, if it grows to a big size and then there's big redemptions, Apollo might not buy all of the securities that the ETF wants to sell it. What happens then? It might have to unload, some of the other parts of its
Yeah,
portfolio, those
I'm
public
not.
credit securities.
I'm
Yeah,
not even clear how they're doing the valuations on this because that's the thing about illiquid investments is that they're not priced daily. So you don't
yeah,
really, I mean, how are they going to say what the proxy strategies, the ETFs I mentioned earlier, those are different. Those are tracking an index of essentially publicly traded securities. So that's not going to have an issue. But this, if you got 10 to 35% invested in illiquids, how are they got to come up with like some kind of valuation for that slice live all the
yeah,
time. These are
yeah.
ETFs. This isn't even an end of the day thing. They've got to every single trade has to have some kind of price for that stuff.
Exactly. And the price they're going to put on it during good times is obviously going to be very different than the price you could potentially get during bad times when no one
Hmm.
wants to buy this stuff. So, yeah,
Yeah.
it's a lot to grapple with here, but we got to keep a close eye on this ETF. This is definitely one of the more interesting and groundbreaking funds that we've seen recently. We'll be keeping a close eye on it. All right. Well, I think that's a great place to wrap things up. I want to thank all our listeners for tuning into Exchange Traded Fridays. Remember, if you haven't already, subscribe and follow us wherever you get your podcasts. And if you have a question or want to share your thoughts, join the conversation with us on X. Our handle there is ETFCOM. Catch you next week.